Oil prices and inflation have reached sky-high levels. Interest rate hikes have not stopped, and there is a lot of speculation in the market. So the question is, what's next? In this video, Real Vision CEO Raoul Pal joins Robert Kiyosaki on the Rich Dad radio show, where he explains how our current situation is similar to situations in the past. We've done videos on both Robert and Raoul Pal before, but make sure you stick around as they have insights that could help you prepare your investments for the forthcoming months. Thanks for all the support you've shown our channel. Let's dive right into the video.
Davos, Switzerland, the IMF says we're heading into the worst financial headwinds since World War II. So your global macro, what does that mean for the world, Raoul?
This is about as macro an environment as I've ever seen. And I think most people's read on it is probably wrong right now. Okay, let's go back and say, I'm going to take you through a history lesson. Good. And then we'll get to today.
That's
and
macro.
I'll tell you why I'm concerned.
Yeah.
So why World War II? World War II was a fascinating period because, like COVID, the entire world had basically been stuck at home or been on battlefields. Everyone came back. There was no supply of commodities and goods. Global supply chains were broken, and everybody came back and started consuming again. And guess what? Inflation went up to 13% or something, maybe even higher. That period was fascinating because interest rates went up, and the first thing that happened was the economy went straight back into recession and inflation went negative. Because it was a massive tightening of monetary conditions. You raised the cost of goods on people and didn't raise their salaries enough. People couldn't get the goods that they wanted, exactly like now, and everything collapsed. So we went back into recession, and then eventually some better times. And I'll come back into the 1940s and 50s because I think it's a really important parallel that most people misunderstand. The next time we saw anything remotely like this was 1974. A lot of people tell you it's the 70s again, inflation. Well, the inflation episode we had in the late 70s was driven by demographics. That was the baby boomers entering the workforce all at the same time. It was the largest demand shock the world had ever seen. And we had a supply shock of this oil crisis of the Arab oil embargo. That's not repeating now. What is actually more similar is 1974. 1974 was the Arab oil embargo. The price of oil tripled. Interest rates went up. Inflation shot up. And the immediate effect was the economy went down the toilet. Almost do not pass go. The stock market fell 50%. And the ISM survey, which is a good guide to the business cycle, it's the Institute of Supply Managers survey. Anytime it crosses below 50, suggests the economy is getting weak. A recession comes at about 47. It hit 30, which was the lowest in all history. And it happened in a space of 4 months. It went from roughly where it is today, which is around 55, and went to the lowest level in 4 months, based on exactly the same kind of setup we've got now.
So are you saying that the 70s are now pretty close?
Yes, and inflation fell in 1974 afterwards. People are still thinking inflation goes on forever. It did not, and it did not in the 1940s either.
In this first clip, Robert Kiyosaki defers to Raoul Pal on what his view is on the current economic situation. Raoul Pal compared the ongoing pandemic to World War II, where according to him, there is a huge similarity between the behavior of the market between both periods. Lockdowns forced people to stay at home just like how the war did. There were also similar problems in the supply chains of both periods which triggered inflation. Consequently, severe monetary tightening due to inflation caused recessions on both periods, and an economic crisis in 1945 wherein the US GDP contracted by 11%. To put it in perspective, the US GDP contracted by only 0.6% last quarter, so this whole situation could get much worse. However, Raoul Pal does state that after all the economic troubles, the economy saw better days in the following decades. Raoul Pal also disagrees that the current economic climate is similar to the inflationary situation of the late 1970s, stating that the two periods were not similar at all. However, he does say that the 1974 economic climate is closer to the current situation, wherein inflation did fall. In this next clip, Raoul Pal goes on about similar economic situations in history.
Then the next one up is 1984. 1984, we saw an issue where global trade, there was a huge amount of trade disputes. The dollar was pretty strong, like it is now. Interest rates were going up and inflation was high. And everybody was fearing, looking back and saying, oh, we don't want the early 80s, late 70s again, the inflation. So Volcker was tightening rates too much and the economy collapsed. It didn't go to recession because the Fed quickly started cutting rates, but the dollar went up a lot more and created a lot more problems. We ended up with the Plaza Accord in 1985 when everybody had to stop the dollar going up from destroying the global economy. So then the next time we see something similar, 2008. 2008, if you remember, the oil price was at $147. Inflation was 6%. The Fed had been cutting into that because the economy was imploding. 2018, exactly the same. Oil prices high, inflation high, the Fed were hiking rates, trying to tighten the balance sheet, and what happened is the economy rolled over really quickly again. Okay, so what's going on here? Why does this phenomena keep happening? Everyone extrapolates inflation out forever. What actually happens, consumption falls because we've tightened monetary conditions. Tightening monetary conditions to ordinary people means the cost of your mortgage has gone up at the fastest pace in history. Over a 1 year period, mortgage rates have never risen this fast. So any money you borrowed has suddenly got much more expensive. Your wages haven't kept up with the cost of just basic services like food. So you're actually feeling poorer, so you can't consume as much, and you start not consuming other things. People overextended on housing because they rushed into housing in 2020 and 2021. Rates have gone up for them. Also, just the rise in things like the cost of oil has meant that, gas prices, all of this stuff. And then the rise in the dollar, which is a monetary tightening. All of these things get together would suggest, and I put them on a chart, it suggests that the ISM is going back to 30, which is as it was in 1974, which is a terrifying fall. Now, what
does ISM stand for?
Institute of Supply Management. It's the survey of buyers at corporations who buy goods and services. They ask them, what is your read on the economy? How much inventory have you got? What are prices paid like? That kind of stuff. And they create these surveys, and they're readily available online, and you can have a look at them. And they go up and down with the economy. They tend to lead the economy. And it's suggesting that if we're not careful, we could have a very sharp, nasty recession, meaning kind of a negative 5% GDP recession. It might be short, depending what the Fed does, and we'll come on to that in a bit. So we've got the setup that we've seen many times in the past. We've got the forward-looking indicators, this monetary tightening, suggesting we've got some real pain to come. Then the anecdotal evidence, we're seeing all the tech companies who were bulletproof laying off staff and giving earnings warnings because everybody can't raise prices enough, so their margins are falling and people have overextended. Amazon said, we've hired too many people. They're one of the biggest employers in the United States. Okay, this is not good, but the answer to higher prices is higher prices. And that's what's happened. And everybody's looking around you themselves saying, well, what's going to break when stuff like this happens? The market goes down, something's going to break. We're looking, what bank is it? What hedge fund is it? The actual answer is, it's the economy. The economy has just broken, and the Fed are going to have to pivot.
And that's what the IMF is saying in Davos yesterday.
They're saying, and it's dead right, the monetary conditions that we've imposed on corporates and people is the biggest tightening in all history. We've also got China slowing down very fast because the lockdowns, but also they've been in recession. So we've got and Europe with a war and having to deal with this energy transition. So we've got no leg of global growth here.
Raoul Pal first takes note of the 1984 economic collapse due to over-tightening by the Fed. In this period, the dollar was close to powerful and was able to cause a global economic crisis. Raoul Pal also pointed out oil prices in 2008, wherein a barrel of oil was at $147 and inflation was at 6%. He says that this was similar to 2018 when oil was starting to get expensive and inflation was also at a relatively high level. In all of these periods, the Fed hiked interest rates and caused damage to the economy. This phenomenon is caused by over-tightening, which in turn reduces the purchasing power of regular consumers whilst increasing prices of commodities such as food. Raoul Pal also says that the data could possibly point to another 1974 situation. So what does this mean? Well, according to Raoul Pal, it could mean that the economy is bound for a massive downturn, which we are already experiencing. Raoul Pal concludes that when the smoke clears, not just some hedge fund will collapse, but the entire economy, which could prevent any global economic growth from happening. What did you guys think of Raoul Pal's analysis? Do you believe that 1970 could repeat itself? Give us your thoughts in the comment section down below. If you enjoyed this video, give us a like and subscribe. And we'll catch you on the next one.